Good afternoon, and thank you everyone for joining us today. I'm James Fields, President of Klingenstein Fields Advisors, and I'm glad you could join this call. With me today on the line is Ralph Sinsheimer, Senior Managing Director at Klingenstein Fields Advisors. Ralph is a senior member of the investment team and also heads up the Manager Research Group at Klingenstein Fields Advisors. Please join me in welcoming Ralph. We hope everyone is staying healthy and safe as we see the COVID numbers on the uptick, with colder weather coming and COVID fatigue hitting many people. And the governmental responses from the spring are returning, at least in part, to try to slow the spread of the virus. We'd like to wish everyone a happy Thanksgiving a week in advance. I'm sure for many it will be very different this year, but we hope you'll be able to spend time with friends and family, whether it's in person or virtually. We are especially grateful to our clients, partners, friends, families, and other loved ones this year. We appreciate the trust and confidence that you've placed in us to help you navigate through these challenging times. So as we all know, Election Day was on Tuesday, November 3rd. Although due to COVID, many voters this year cast their votes either through early in-person voting or absentee ballots. Regardless of how you voted, the voter turnout rate is already the highest it has been since the 1960s, and it's projected to possibly be the highest rate since the early 1900s. Certainly, in absolute numbers, it is a record breaker, with more than 152 million ballots counted as of November 16th. After a hard-fought race by both presidential candidates, it appears that former Vice President Joe Biden will win more than the 270 electors in the Electoral College. If that stands, Kamala Harris is poised to become the first woman and first person of color vice president, a great testament to our country. This election, not long after 8 years of President Obama, sends a strong message of progress and commitment to diversity, inclusiveness, and equal opportunities for all, goals that we at KF Advisors strongly support. Our firm pledges to work for and encourage these goals in whatever way we are able to in our own personal and business lives, and regardless of whether or not we agree on the policy stances of the individuals. While we may hold differing political views at KF Advisors and affiliate with different political parties, we all join together to congratulate our nation on its every 4-year celebration of democracy. We believe that now is the time to set differences aside and work together to heal and move forward, doing all that we can to help one another stay safe and healthy and to help the country recover socially and economically. With that said, any change in administration means shifts in tone, views, and goals, all of which can affect monetary and fiscal policy, the economic outlook, the financial markets, and of course, individual investment strategy. Today, we're going to discuss the election and implications for the short term, as well as what the election may mean for 2021 and beyond. As always, we stress that in addition to considering the macro environment, we develop our customized investment strategies in the context of your specific situation, factors and objectives and goals unique to you. The areas we will cover today are a brief discussion of the presidential and congressional election results, the market reaction, and what we see ahead for the rest of 2020 and our outlook for 2021. We will also cover how recent vaccine news affects our thoughts regarding 2021 and potential timing for the full reopening of the global economy. Then we'll open up to questions and look forward to any that you may have. We usually get more questions than we have time to answer during the call, but any questions that we do not get to on the call, we will follow up with you individually to make sure that they are addressed. During this call, you can submit questions anytime in one of two ways. If you are listening through your computer, there's a widget on the right side where you can submit questions. Or you can email questions to Mildred Pallo, and that's mildred.pallo@klingenstein.com, which is KLINGENSTEIN.com. No doubt everyone has been watching the political landscape intensely over the last few weeks, if not longer. You may even be tired of hearing about it. So we're just going to briefly run through the results. As I noted, was a historic election with turnout rates unusually high and a record number of voters in absolute terms. Due to the pandemic, a much larger percentage of voters than usual voted early or by absentee, which may have contributed to the, quote, get out the vote from both parties. Although in light of the intense election season, both parties also spent unprecedented hours and dollars to encourage voting. Georgia's election count was very close, resulting in a recount which began on November 13th. With a deadline of finishing it by yesterday, Wednesday the 18th, and results to be certified by Friday by Georgia Secretary of State Brad Raffensperger. With Georgia going to a by-hand recount and a few other states' outcomes not fully confirmed, there has not been a formal declaration of a, quote, victor. While at this point, all major press outlets have called the race for Joe Biden and Kamala Harris, the media does not certify election results. And while nothing is official until electors cast their ballots on December 14th, and the Congress counts and certifies the results on January 6th, 2021, and there are scenarios which could impede the official result at this point, they are highly unlikely. Of equal significance is what went on in the congressional races. There was conjecture and polling prior to the election that there would be a, quote, blue wave, where Democrats would win the presidential election, keep their majority in the House, and win enough seats in the Senate to obtain the majority. The blue wave did not materialize. The Democrats, in fact, lost some seats in the House, although they still hold the majority. On the Senate side, the count currently stands at 50 seats for the Republicans. The remaining 2 seats will not be decided until the runoff elections, the 2 Georgian seats, where 50% majority is required in early January. There presents a potential path by which the Democrats could reach the majority, although it does not seem likely to happen at this time. In the event of an evenly split Senate, as you may know, the vice president becomes a tie-breaking vote. As of today, subject to the Georgia recount, the first of the 2 Georgia seats will be contested between Republican David Perdue, who won 49.7% of the votes, and Democrat Jon Ossoff, who won 48%. The remaining 2.3% went to Shane Hazel, a Libertarian. This is a very tough one to call, as Libertarian views cannot easily be categorized as belonging to one or other of the major parties. The second election runoff will be contested by Democrat Ralph Warnock, who won 32.9% of the vote, and Republican Kelly Loeffler, who won 25.9%. However, the third candidate in that race was another Republican, Doug Collins, who amassed a significant 19.9% of the total votes. If his votes go to Kelly Loeffler, then she will keep her seat. The Republicans will retain the majority in the Senate, even if David Perdue does not win. All this brings us to what's going on in the financial markets, an area where we hope to advise and guide you regardless of the final election outcomes. The markets are forward-looking and prefer certainty, although ideally positive news. They prefer balance and a lack of extreme events and actions. Post-election market performance has thus far been quite strong. While this is partially attributed to positive vaccine news from Pfizer and Moderna, it is our view that a divided Congress is what the markets are, quote, betting on and hoping for to avoid any extremes. Although, as we said in our post-election email, this is 2020, so never say never. And with that, I'll hand it over to Ralph Sinsheimer.
Thanks, James, for that clear and concise recap. And with apologies to Dinah Washington, what a difference a fortnight makes. 2 weeks ago, on the eve of the election, there were several questions weighing on the market. At the time, answers were hard to come by, making it difficult to develop short and long-term market projections with any real confidence. However, since Election Day, we have more clarity and can provide some answers. The first unknown on November 3rd was who would win the presidency and the Senate. We now know that barring a successful court challenge, Joe Biden will become our 46th president, and neither the House nor the Senate are likely to flip. Although, as James reported, the 2 Georgia runoff elections are still ahead of us. This means divided government, and markets prefer divided market over unified regimes. Since 1944, the S&P has enjoyed average annual returns of 16% in those years when a split Congress joins the Democratic president. Gridlock and the check on the more extreme positions of either party seems to be coveted. This is a good sign for the market. The next and most pressing issue is what progress will we make in controlling COVID-19? What we now know that we didn't know 2 weeks ago is that the elusive search for an effective vaccine would bear fruit sooner than expected and with more efficacy than we could have hoped for. This really is a game changer and will be critical in the calculus needed to formulate market calls. Unfortunately, the virulence of the COVID-19's next wave and the dire warnings from experts does offset some of the impact of the vaccine's good news, and in fact could have a devastating effect on the population and the economy over the next 6 to 12 months. So besides the early giddy investor reaction to the Pfizer and Moderna test results, the markets will need to contend with the onslaught of high daily case numbers and related deaths, leading, of course, to more shutdowns for the next several quarters. Another question revolves around the next stimulus package. Will there be one? And if so, what might be the timing and magnitude of the program? There is general agreement that a meaningful program is needed and needed as soon as possible. The when may be dependent on how President Trump views his interim status. If he wants to forcefully broker a stimulus bill in the next several weeks, and House Democrats are willing, of course it has a chance. In fact, the fact that the election didn't result in the anticipated blue wave partially obviates the need for Democrats to wait until January. While any delay could be very harmful to small businesses and the recovery, the lagged impact of previous monetary stimulus could provide a cushion when we most need it, which is prior to the broad distribution of the vaccines. The rebound in corporate earnings has been impressive, and we expect this to continue, even as some industries come under pressure due to quarantine protocols. Manufacturing, particularly in the automotive sector, has been on a tear, as has anything related to the housing sector. Consensus S&P 500 earnings are projected to grow 23.5% for 2021 and another 15.5% in 2022. Applying a 20-time multiple, equities look fairly valued. Additionally, when you compare the 3.5% earnings yield of the market to the paltry 10-year Treasury yield of 0.9%, the decision to overweight equities is made easier. Further, divided government should result in the dilution of the Biden tax plan, which in its purest form would raise most corporate tax rates from 21 to 28%, and thereby negatively affecting corporate profits. So from a policy perspective, the result of divided government is the likelihood that material changes in tax and regulatory legislation will not be passed. This suggests, again, good news for corporate earnings and the valuation of the market. Still, in the short term, we expect a risk-off market to follow this upsurge of the past couple of weeks. Markets hate uncertainty, especially at a cyclical, sensitive point, which is exacerbated by the lame duck nature of the next few months, as well as the intractable legal maneuvering we have been told to expect and the sobering reality of rising COVID-19 cases. This dampens the macro backdrop and leads to the reassertion of a slow growth environment. Accordingly, we look to U.S. equities, including tech and healthcare, and our long-term equity view remains positive, as historical data has shown that investing in equities has delivered long-term strong growth potential. As for bonds, we know that at their November FOMC meeting, the Federal Reserve reiterated its commitment to keep rates low for an extended period of time and continue its asset purchases. The dual goals of this stance are to help facilitate the recovery and to foster job growth while allowing inflation to rise slightly above 2%, a more acceptable level than it is today. Neither of these moves are a surprise, as lower for longer have been watchwords since the Fed reduced rates earlier this year in response to the economic shutdown. We have no expectation that the Fed will push rates into negative territory, and therefore we expect prices and yields to remain relatively steady for the foreseeable future. There has been some spread tightening of corporate and emerging market bond yields, and we anticipate that they will continue to narrow. In this seemingly unfavorable environment for bonds, the role of fixed income is to provide a flight to quality security for treasuries and other U.S. government-backed bonds, and a modestly enhanced yield for more convex bonds. In any event, we are positioned to be underweight bonds and overweight equities for the mid and long term, given the Fed's continued support and the prospect for economic improvement following a very difficult few quarters. And with that, I'll hand it back to James.
Thank you so much, Ralph, for that. So that's where we see the United States in terms of short-term and long-term themes and outcomes. Currently, there's uncertainty regarding the Senate, which may lead to some short-term market volatility, particularly leading up to January 5th. But overall, we are cautiously optimistic that we are on the road to a mid-end year resumption of a more, quote, normal world. We hope that this was helpful, and we encourage you to continue to reach out to us with any questions you may have. We will continue to monitor the situation and developments carefully and keep you informed. We always welcome the opportunity to discuss our thinking and approach and encourage you to reach out to your advisor with any questions on your individual portfolio. At this time, I'd like to open up the call to questions. Again, if you are listening through your computer, you can submit questions through the widget on the right side of your screen. Alternatively, you can email questions to mildredpalo@klingenstein.com. It's MILDRED.PALO@KLINGENSTEIN.com.
Thank you, James and Ralph. That was a really informative discussion, and I can tell by the questions coming in that your perspectives and thoughts were really of interest to our listeners. We're going to try to get to as many questions as possible, but if we don't, we will follow up with you personally and appreciate your interest. So I'm going to give the first question that we got to Ralph, and that's back on the fixed income markets. Given the tough economic times that many states are having due to the pandemic and with the surge and additional municipalities shutting down again, what's your outlook for the muni markets and how do they play into a portfolio, particularly for taxable portfolios?
I think, unfortunately, my view is not yet bleak, but it's certainly not positive. It doesn't take a genius to figure out that the level of tax receipts are going to be dramatically cut, and those are supporting the bond payments. While bankruptcy is not a day-to-day occurrence in the muni world, it could become more frequent, and I expect it would be. So we're lowering our allocation to munis.
Great, thank you. Great answer. Another great question, which is somewhat related in terms of potential fiscal stimulus. What level do you see being approved given the probable split in the political parties, and how do you see that affecting state and local economies? I'm going to give that to you, James.
Thanks, Ellen. That's a great question. It seems clear that both parties in Washington want to get something done. On the other hand, that's been clear for several months. And the gap between the, quote, skinny Mitch McConnell bill of $500 billion and the $2.2 to $2.5 trillion bill that the House Democrats prefer, that gap has not seemed to narrow materially in the last few weeks. I do expect, with the increase in the COVID numbers and the associated shutdowns, that the pressure will increase dramatically on both parties. And as Ralph noted, the likely outcome of this election takes some of the pressure off both parties to make concessions and be able to deliver something to the American people by the end of the year. It is clear, though, without that, and depending on which bill is passed, one of the primary differences between the bills is the amount of state and local government support. And so I think it's not just the size, but it's the nature of the bill that ultimately matters. I would like to think that some compromise would be reached. At one point, the White House had offered $1.6 trillion, possibly as much as $1.8 trillion. And if that can be revisited, there's a chance that that gets passed.
I would just make an additional comment, and that's the idea that the stimulus that's already passed has not all been spent. And there is a delay between the programs that are enacted and the money that is passed in legislation. So even if it turns out it's 1.2 trillion, there is something like another trillion waiting to be used. So that's some comfort.
Terrific. Thanks, James. Thanks, Ralph. Another really good question related to employment. Recent employment numbers were a bit better than expected. What are your expectations over the next 6 months or so for jobs, employment recovery, and how will that impact the economy? I'm going to give that one to James.
Thanks, Ellen. Obviously, employment, such an important issue. So today's numbers on the weekly employment claims were slightly worse than expected, but the overall level of employment was slightly better than expected. And that's been the trend we've seen recently, is that it seems that while there are more people looking for jobs each week, that the absorption of employment into the economy has improved recently. And if you'd asked this even 2 weeks ago, I think we'd be even more bullish on that trend continuing. Now we're at a point in time with the increase in the number of cases, even though the mortality rates have stayed low, that if local governments return to the policies of the spring, that we will once again, as we did see in the spring, see a fair number of layoffs, particularly in some of the highly sensitive hospitality-related industries that have been trying to survive and yet may be shut down again. So I think we have sort of a modest view on employment. The underlying fundamentals of the economy are quite strong, but it is very much sector-driven and very much a local phenomenon, where you've seen certain states, particularly in the Southeast and West, continue to have relatively strong employment. And then some of the harder hit COVID states in the Northeast, Pacific Northwest have greater unemployment. So it's very much become a local and regional phenomenon.
Great, thanks so much. Question about liquidity. I'll give this to you, Ralph. In the current environment, in the current market, do you think that people should be taking steps to protect or immunize liquidity?
Well, it's always a good idea to figure out what your irreducible minimum is, and to have that as a store of cash or whatever. It could be gold as well, for all you know. So the answer is I do think so. I think things can go wrong in this kind of environment. We don't know what the next 3 to 5 months look like with the virus, and that could cause knock-on things that are not terribly good. So we're not expecting it, but we do think you might want to think about a year or two's worth of living expenses put to the side.
Great, thanks, Ralph. Another question for you, James. Something that's been of concern, regardless of which political party has been in power, is the fact that deficits continue to grow in the American economy and governmentally. What do you view the long-term implications of deficits on the economy and the markets?
Thanks, Ellen. That's a great question. And it's become an increasingly debatable question in the last few years with the rise of what they call modern monetary theory. Ultimately, history shows that you cannot run deficits forever. That at some point, there's an amount of debt, indeterminate in specificity, for any one economy can support. And as Japan has proved, that number can continue to go up for a long, long period of time, but not without consequence. And so our view is that while deficits have not seemed to matter from the point of view of economic growth, deficits have not seemed to matter in the point of view of the financial markets, there will be a point at which there is too much debt, and the adjustments to deal with that debt will have to come through either inflation or decreases in the currency, which can cause inflation. A number of things that can cause inflation, either increased printing of money or devaluation of the currency. It cannot go on forever. That's the classical theory. That was the way that many of us were trained, and I think was still our point of view. What we don't know, though, is what is that number? Is that 100% of GDP? Is it 200% of GDP? And none of these are in a vacuum. So it is also the case that there's the absolute number of debt an economy can hold, and then also how is that debt and the performance of that economy vis-a-vis the other alternatives for capital. One thing that every government has learned, regardless of its point of view, is capital can move and does move much more easily than people and equipment. And what you find is the capital will find its best place of return over time. And if everyone is levering, which is what's been happening, it may not matter as much versus if you're the only country adding high leverage. But the short answer is I think it will matter, just a question of when, and it's likely not in the next few years.
Thanks so much. That was a really good answer. A couple of questions I've gotten a number around these, and I'm going to give this to you, Ralph. They're all kind of related, and it's about the sort of close split in power. If it becomes a gridlock, becomes permanent, how could that affect the economy and the markets? Sort of related, how does that affect the ability to really get anything done in a major kind of way?
Yeah, it will be difficult for the Democrats' agenda to get through the Senate in anything but a highly watered down version, particularly where tax hikes are concerned. I do think there are some issues where both parties can come together. These include a toned down version of a fiscal package, which we just talked about, and prescription drug pricing reform. Those are two. But I think Biden is going to have to implement elements of his plan by executive order, just as President Trump has done. And for those who are politically centrist, one positive that arises from the narrow margin in the Senate, a slight majority either way could translate into more leverage and relevance for the moderates in both parties. This and the Biden-McConnell friendship could make a difference at the margin. An optimist might even be correct in expecting a perceptible change in tone in Washington, but don't yet hold your breath.
Thanks, Ralph. Really good. I'm going to give this one to you also, Ralph. Both parties have talked a reasonably tough game about trade policy, global trade and trade policy, particularly related to China. Assuming that it is President Biden that takes power in January, do you see a change given him as president and again the split in Congress? Do you see a change in action, in tone, etc.?
I do. I think that at the very least there'll be less unilateral actions taken and a partial return in direction of globalism. In China, for example, as you brought up, Biden is likely to rely on allies and more traditional means of diplomacy when dealing with the second largest economy in the world. I think he will soften the tone, but his labor union constituency will expect a firm backbone. He may muddy the waters by making human rights a central part of any negotiation. And we'll see how well that goes.
Thanks, Ralph. Question for you, James. Last webinar, you talked about some significant proposed changes to income and estate taxes and some actions that could be taken preemptively. If he becomes president, but the Congress is split, what's the likelihood they would go through? And if they don't go through, but maybe I've already started making some of those changes, what would you recommend doing?
Sure. Yeah, a good set of questions. And frankly, for all of you out there, our clients, one of the most relevant issues about what happens in the Senate. I do think if the Senate does not flip and stays with the GOP, that will moderate, if not eliminate, most of the, from a percentage perspective, dramatic increases proposed by Vice President Biden to tax policy, particularly for individuals making more than $400,000 a year, and for businesses. As Ralph noted, the corporate tax would go up dramatically. So I think if the Congress stays as it's been and the Senate stays within, that will either likely not happen or be quite a bit moderated and watered down. As to if you've already done some planning, should you hit pause? I think the answer to that is no. And I think the reason for that is regardless of what happens, taxes are not going down. There is no scenario where taxes are going down with a Biden-Harris administration. There's a chance that they don't go up if the Senate stays, but there's no chance it goes down. And in that sense, taking actions this year that were based on the fact that taxes likely will go up in a blue wave are likely still relevant, but of course, that relevancy is on a case-by-case individual basis.
Great, thanks, James. Next question, back to you, Ralph. Sort of related to some of the questions you discussed a minute ago. In terms of climate control, environmental protection, and what might happen there, any idea what that could be and what impact on companies and or sectors that might have?
So again, an interesting area. Biden has already indicated that he would rejoin the Paris Agreement as soon as possible. And as you know, Trump pulled out of the accord effective November 4th. I guess you needed a full year's notice to do that. There is bipartisan support for infrastructure spending generally, and making it climate friendly won't change that. The business community is starting to become increasingly vocal, so there will be more bipartisan efforts in this space, I believe. However, the need to pass a comprehensive COVID fiscal package, it would be hard to convince Republicans to vote for another large spending bill soon after. So while a fully blown Green Deal may not be in the offing, a ban on fracking on public lands, for example, may be. So we'll see some steps towards it. Good question. Thank you.
Great. Thanks, Ralph. Another great question came in by email. You talked a little bit about the senatorial runoff races. What do you think the chances are that the Democrats could, in fact, carry both races? And if so, what would that mean? I'm going to give that to you, James.
Thank you, Ellen. Well, it's certainly possible, right? We're seeing unprecedented amounts of money being spent in Georgia from all over the country by both parties. And as we know, during the general election, the Democrats spent more money than had ever been spent by quite a large factor, and well more than the Republicans did. So I think the outcome is certainly not clear. And the reason there are runoffs is because there was no clear majority winner on either of those races. So I certainly think it's not a guarantee. Now, historically speaking, it would be a dramatic change if Georgia were to have two Democratic senators. At the same time, as of this morning at least, there was a slight lead in terms of the hand recount for Vice President Biden in Georgia. And again, that would be a historically anomalous outcome were the Democratic candidate to win Georgia. So I think anything is possible. And I think that is going to have a dramatic effect. If it ends up that they win both seats, and it's 50-50 with the vice president breaking any ties, that will have a dramatic potential impact on policy. Although, as Ralph noted, a Senate that close tends to lend power to the moderates. And there are certainly a number of Democratic senators in states like West Virginia, Joe Manchin and others, who, while they are certainly caucus and with the Democratic Party are Democrats, their constituency tends to be quite conservative, and they are not a lock to go along and lock in step with Mr. Schumer and other leadership of the Democrats in the Senate.
Great,
I would just add that a trifecta for the Democrats is not priced into the market. I think we'd see a little backtracking if that were the case.
Great. Thanks,
Great
James.
point,
Thanks, Ralph. Yeah, no, that is a great point. A couple of related questions, which are really good and something I think we've all been thinking about. What do you see the impact of a possible fundamental shift from in-person to virtual workplace, at least maybe not fully, but partly? And related to that, what do you see in terms of commercial real estate in that sector? I think I'm going to give that to both of you or either of you.
I'll be gallant and let James go.
Oh, okay. I'm more than happy to. Thank you, Ellen. This really is an interesting question. And regardless of what industry you work in, this has impacted you, even if you're not someone who has been able to shift to work from home. And I have to say, we at Klingenstein Fields Advisors have been very fortunate in that we had the technology and are in an industry where that was not a difficult switch for us, and frankly, it's been quite seamless. I think this has a dramatic impact in the future of the economy. And it's something we've been anticipating indirectly, in that we have, over the last several years, focused more and more of our investing around technology and on new technologies and on e-commerce and on all the things that have had an acceleration in their growth during the pandemic. I think those trends will likely stick at some level, and certainly things, physical retail has been damaged, and commercial real estate, I think, is not as clear cut. It is an interesting case that sort of core large cities have been badly hurt, but suburban office has benefited, and a number of other areas where you can bring people together in smaller groups have benefited. So it's going to be, again, somewhat idiosyncratic based on the type of properties that you have. But I think the working from home, the technology-enabled working from home, working mobilely, the cultural shift that we've heard in almost every industry that's been able to do this, of wanting to keep some of in-person contact, but being comfortable with the fact that you can be productive in what we would call a non-traditional work setting, those are likely to stick, as are things such as grocery shopping from home. And you saw there was a transaction today with Ahold buying Fresh Direct, partly to take advantage of that. So there's a number of features that we think will stick in part post the wide distribution of a vaccine and hopefully the containment of COVID, so it becomes more like the annual influenza.
Great, thank you. Related somewhat, but on the flip side, I would say fundamental impact of the virus and its after effects and sort of length it will last on leisure, entertainment, and travel sectors. It was a question that came in, which is a really good question. Ralph?
I just think it's as simple as, depending on the depth and length of the shutdowns, that will test whether or not some of these companies or whole sectors can survive. I don't have a clear answer to that, but if you have your own set of the duration of this, you can pretty much figure out how long these companies can last. I'm surprised as many have lasted, quite frankly. But with the news of the vaccine, I think they'll do everything in their power and everything they can do to get their share of a stimulus package to make it through this dark night into the brighter day of what we think will be early summer of next year.
Great, thank you, Ralph. I think we have time for perhaps a couple more questions. This one I'm going to send your way, James. In terms of private investing, what do you see the outlook under both given the virus scenario and the political scenario for 2021?
Well, private investing and private businesses have done quite well during not only the pandemic, but over the last several years. Many reasons for that. There's been tremendous capital on the sidelines. There's been demand for risk and return, which has fed venture capital and private investing in general. So I think we believe that will continue. What is interesting, again, getting back to what happens in the Senate, is there was certainly a movement afoot to change how carried interest is taxed, and some of the tax advantages, you might say, or certainly tax policies that are beneficial to private investing and long-term capital formation and capital gains creation. And were there to be a Democratic Senate, that is a very low-hanging fruit, very easily saleable to the populace tax increase that affects a very small percentage of the capital markets, and yet has great headline value. So I think you could see that, which of course, anytime you increase the cost of doing any type of business, which is what a tax is, you decrease the amount of that business you get. So it certainly would have a deleterious effect on private investing. But we certainly continue to believe that, and we've seen this even during the pandemic, the American spirit of entrepreneurship has not been quashed by COVID, has not been quashed by the response to COVID. If anything, it's been accelerated as people have felt that the traditional ways of finding their next stage of their career may not be available to them, and that they have to be more creative. So I certainly think that culture will remain, and in an increased regulatory environment and tax regime, it will be more expensive, but it will not die.
Thanks, James. Great answer. Another question, a couple questions really around currencies, what you see the outlook in terms of the dollar. Do you anticipate continued weakening of the US dollar, and what will be the impact on both trade as well as investing? Ralph?
So the dollar is down and has been for a while. I think it reached its 2-year low in July. This has helped domestic stocks, especially for the multinationals. And that could continue. I think the dollar has devalued because of the vast government borrowings that we've had, which is financed by an unlimited monetary expansion. So inflation is in check for now, but I think once excess capacity is exhausted and expectations rise, the dollar will be floating in a range and not reach its highs of last year.
All right, thanks, Ralph. I think this will probably be our last question for James. The virus news in terms of the surge, as Ralph alluded to, seems to be getting worse, not better. We just saw that New York City is closing its schools for in-person learning. Where do we think that's going to get worse, and could that change the outlook for the economy and the markets even for 2021 as opposed to just the near term?
Sure, thank you, Ellen. It's a great question, and clearly I don't know the actual specific answer. The news flow has been so interesting in the last 10 days on the virus. 2 phenomenal vaccines created by private industry have come to the market with efficacy rates that are almost unheard of. There's really only 2 other vaccines for disease on the market with that sort of high efficacy rate. You've had a couple of therapeutics, Eli Lilly's being one, in addition to remdesivir, on the market, which are helping treat patients across the spectrum in terms of being those who are somewhat ill to those who are very ill, as well as our better ability to manage patients in the hospital who do get very sick. And that's why you're seeing that even with the dramatic increase in the number of positive cases, we have not seen the associated, at least on the curve, sense of mortality, and we hope that continues. At the same time, we are starting to see the governmental response. And again, to be clear, what drove what happened in the financial markets and the economy was not the virus. It was the response to the virus. And that's been made clear in this country as well as it's been made clear in other countries that handle the response quite differently. And I think if we continue to see the larger populations, California, New York, and others, start to lock down their economies again, you are going to have a negative effect. And with the big difference being, as Ralph noted, in the spring, we had the stimulus, the $3 trillion of stimulus. And that was one of the things that allowed for the rapid V-shaped recovery we've had in the economy and in employment. Without that sort of support in the face of government lockdowns, I think that the negative consequences of those lockdowns would be much longer felt than certainly with the stimulus plan. So thank you for all those fantastic questions. Thank you all for attending. We hope you found it interesting. Please stay well, and we look forward to speaking with you all again soon.